The opening bell has rung on Wall Street every trading morning for well over 2 centuries, through wars, pandemics, terrorist attacks, and financial panics. And that unbroken rhythm is precisely why almost nobody stops to consider what would actually happen if, one ordinary Monday, it simply did not ring at all. Most Americans picture Wall Street as a distant world of traders shouting numbers on a floor somewhere in lower Manhattan, a place that has nothing to do with their own paycheck or their own life, and yet the machinery humming beneath that image is one of the most load-bearing structures in the entire economy, quietly pricing the retirement accounts, pension funds, mortgages, business loans, and college savings of hundreds of millions of people who will never set foot anywhere near the New York Stock Exchange. Picture David, a 42-year-old engineer living in Ohio. He does not work in finance and has never bought an individual stock in his life, yet his 401k is invested in a target date mutual fund. Tracking the broad market, his wife Rachel runs a small business that depends on a revolving line of credit from a regional bank, and their daughter has a 529 college savings account sitting in a mix of index funds. None of them think about Wall Street on a daily basis because the system has always simply worked silently in the background the way electricity or clean water works until the moment it does not. Then, on an otherwise unremarkable Monday, the opening bell fails to sound. At 9:30 in the morning, the New York Stock Exchange does not open. Minutes later, the Nasdaq goes dark as well. Financial news networks interrupt regular programming with a rolling chyron of confusion. The first assumption from officials is a technical glitch, the kind that has happened before and been fixed within minutes. But as the morning stretches into the afternoon and trading remains frozen across every major venue, the explanation stops sounding routine. This is not pure fiction. In July 2015, the NYSE itself halted trading for nearly 4 hours after a botched software update. And traders that day openly worried the problem could be something more serious than a glitch, before engineers eventually traced it to a corrupted configuration file. What separates a scenario like the one David is living through from that 2015 incident is duration and scope. A shutdown that does not resolve in hours but persists for days, cutting across every exchange simultaneously rather than a single venue. As the freeze continues, confusion cascades through the financial system far faster than most people would expect. Investment firms cannot complete billions of dollars in pending trades. Hedge funds cannot rebalance positions ahead of quarter end. Pension fund managers, responsible for the retirement security of teachers, firefighters, and municipal workers, cannot adjust portfolios to manage risk. Companies that had scheduled a stock offering to raise capital for expansion suddenly lose access to one of the primary channels businesses use to fund growth, hire workers, and invest in research. The entire apparatus of price discovery, the constant second-by-second process by which millions of buyers and sellers agree on what an asset is actually worth, simply stops. David watches the news with a knot in his stomach. His retirement account still technically exists. The shares are still there, but nobody, not his broker, not the fund manager, not the exchange itself, can currently say what those shares are worth, because a price only exists when somebody is willing to buy and somebody is willing to sell and record that transaction. Rachel gets a call from her bank explaining that approval on her business loan has been pushed back indefinitely because the bank cannot accurately value the collateral or assess broader market risk while the exchanges remain closed. Even companies with strong balance sheets and no direct exposure to the shutdown begin quietly freezing hiring plans because uncertainty of this magnitude makes any kind of confident forward planning nearly impossible. This is precisely the kind of contagion effect financial regulators have spent decades studying. Researchers at the Federal Reserve have specifically flagged the danger of what they call amplification, where a shock that begins as a narrow technical or cyber event spreads through the financial system via shared technology providers, interconnected trading platforms, and the layer of digital infrastructure that virtually every major financial institution now depends on, meaning a single point of failure at one critical vendor or one dominant exchange can ripple outward into a systemic event far larger than the initial disruption. As the shutdown stretches into a second day, the rest of the world begins reacting, even though its own exchanges remain open. European and Asian markets swing wildly as international traders try to price in an American crisis they cannot fully see or measure. Demand for United States Treasury bonds spikes as global investors search for the closest thing to a safe harbor. Gold prices climb, and the value of the dollar lurches unpredictably as currency traders try to reassess American financial risk in real time without the primary reference point they normally rely on. Large corporations feel the pressure almost immediately. Firms that had planned to raise capital through a public stock sale must delay their plans indefinitely. Startups that depend on venture funding tied to eventual public market exits lose access to a critical piece of their financing pipeline. Corporate acquisitions already in progress are paused because neither the buyer nor the seller can establish an accurate valuation for the company changing hands. Confidence, the intangible force that keeps the entire system moving, begins visibly eroding by the hour. Behind closed doors in Washington and New York, an extraordinary coordination effort kicks into gear. Financial regulators at the Securities and Exchange Commission, engineers from the exchanges themselves, cybersecurity specialists from federal agencies, and officials at the Federal Reserve work around the clock trying to determine whether this event stems from a catastrophic technical failure, a deliberate cyber attack, or some other cause entirely. This detail is not far-fetched. The Federal Reserve has published formal research warning that cyber risk has become one of the top concerns cited in financial stability surveys around the world, and has explicitly modeled scenarios in which a targeted attack on a single major trading platform could cascade through the interconnected web of exchanges, clearinghouses, and settlement systems that keep modern markets functioning. Precisely the kind of network of networks vulnerability that turns a contained incident into a systemic one. The Department of Homeland Security has separately warned that the American financial sector has historically been viewed by hostile foreign actors as a priority target, and cybersecurity researchers tracking the industry heading into this year flagged an accelerating pattern of ransomware attacks, data wiping malware, and third-party vendor breaches capable of exposing millions of accounts at a time. The kind of vulnerability sitting quietly beneath the surface of an industry most people assume is impenetrable simply because it is enormous and well-funded. Meanwhile, out in Ohio and in millions of households just like David and Rachel's, an obvious question starts spreading. If Wall Street is closed, does any of this actually matter to somebody who has never bought a single share of stock in their life? The answer, uncomfortably, is yes, and the scale of that answer is larger than most people realize. Roughly 58% of American adults own stock in some form, according to Gallup's most recent survey data, and the overwhelming majority of that ownership flows through retirement accounts rather than direct brokerage holdings, meaning most people's exposure to the market is invisible to them until something goes wrong. Nearly 9 in 10 adults who have a retirement savings plan also report having money invested in the stock market. And total American household exposure to equities, whether held directly through mutual funds or inside 401k and pension plans, now stretches into the tens of trillions of dollars. Teachers, firefighters, nurses, municipal workers, and factory employees across the country depend on pension funds that are themselves massive institutional investors in the very market that has just gone dark. Banks rely on functioning capital markets to manage risk, price collateral, and allocate credit throughout the broader economy, which is exactly why Rachel's loan gets delayed even though her small business has no direct connection to Wall Street whatsoever. Even people who have never invested a single dollar are indirectly tied to the market through their employer's pension obligations, their insurance company's investment portfolio, or the simple fact that a healthy capital market underpins the corporate hiring and expansion decisions that create jobs in the first place. History offers a sobering set of precedents for what a prolonged market closure actually looks like once it finally ends. After the September 11th attacks in 2001, the New York Stock Exchange and Nasdaq did not reopen for 4 full trading days, the longest closure since the Great Depression. And when trading finally resumed on September 17th, the Dow fell more than 680 points in a single session, a decline of roughly 7%, while the S&P 500 finished that first week down over 11.5%, erasing something in the neighborhood of $1.4 trillion in value in less than a week. The Federal Reserve responded by pumping roughly $100 billion of liquidity into the banking system per day during those first critical days, specifically to prevent the kind of credit freeze that could have turned a national tragedy into a full-blown financial crisis. And remarkably, within about a month, the market had recouped nearly all of its post-attack losses, a recovery that surprised even veteran strategists who had expected far more lasting damage. That resilience is real, but it should not be mistaken for painlessness, because the underlying economy still absorbed enormous costs, including hundreds of thousands of lost jobs in New York City alone, and a wave of small business failures near the affected area that took years to fully repair. The market has also demonstrated, on more than one occasion, just how quickly a functioning system can spiral into chaos even without any external shock at all. On May 6, 2010, in an event now known simply as the Flash Crash, the Dow Jones Industrial Average plunged nearly 1,000 points in about 36 minutes, erasing almost $1 trillion in market value, before recovering almost as quickly as it had fallen. Investigators eventually traced the trigger to a single enormous automated sell order interacting with high-frequency trading algorithms that, faced with unusual conditions, began aggressively dumping positions and effectively pulling liquidity from the market at the exact moment it was needed most, a phenomenon regulators later described as a kind of algorithmic pile-on, where machines built to profit from microsecond-level trading decisions collectively amplified a shock rather than absorbing it. That event, along with the Black Monday crash of October 1987, when the Dow fell more than 22% in a single day with no mechanism in place to slow the bleeding, is the reason modern markets now operate with a layered system of circuit breakers, automatic trading halts triggered whenever the S&P 500 falls 7%, 13%, or 20% from the previous close, each one designed to force a cooling off period so panic does not feed on itself in real time. Those circuit breakers were tested more intensely than at any point in their history during the early days of the COVID-19 pandemic in March 2020, when the level 1 breaker triggered 4 separate times within a span of just 10 trading days, an unprecedented cluster of market-wide halts that had not been seen since the current system was implemented back in 2013, as the S&P 500 ultimately fell about 34% from its February peak to its March low in one of the fastest bear markets ever recorded. In each instance, the 15-minute pause did exactly what it was designed to do, giving traders and algorithms alike a brief window to absorb new information rather than reflexively selling into a falling market. And in every one of those 4 cases, the Federal Reserve moved in tandem with dramatic interest rate cuts and emergency lending programs specifically engineered to keep credit flowing through a financial system that was, for those tense few weeks, closer to seizing up than most people ever realized at the time. What all of these historical episodes share, whether triggered by a terrorist attack, a rogue algorithm, or a global pandemic, is the same underlying lesson that markets are not simply a mechanism for wealthy people to get wealthier, but a piece of critical infrastructure whose sudden interruption ripples outward into corners of the economy that appear, on the surface, to have nothing to do with finance at all. By the 3rd day of the fictional shutdown that opened this story, engineers finally succeed in isolating the cause of the failure and begin the delicate process of restoring trading systems across every affected exchange. When the markets finally reopen, prices swing sharply in both directions as investors try to digest days of accumulated uncertainty all at once, some stocks falling hard before stabilizing, others rallying as relief replaces panic, a pattern that mirrors almost exactly what happened on the reopening days after both 9/11 and the COVID circuit breaker events. The system ultimately survives, just as it always has before. But the closer you look at what actually happened during those days of frozen trading, the clearer it becomes just how thoroughly the modern economy depends on markets functioning normally every single day, without exception. David checks his retirement account once trading resumes and sees that its value has shifted meaningfully in one direction or another, but the number itself is almost beside the point. What actually changes for him is a quiet recalibration of how he thinks about a system he had always taken completely for granted. Wall Street, it turns out, is not simply a stage where wealthy investors place bets on companies they have never visited. It is one of the primary channels through which businesses raise the capital that funds new hiring, through which cities and states finance the bonds that build schools and roads, through which ordinary households build the retirement security they will eventually depend on for decades, and through which raw savings gets converted into the kind of long-term investment that drives innovation forward. When that channel stops flowing, even for a few days, the effects do not stay contained to a trading floor in lower Manhattan. They radiate outward into a small business loan in Ohio, a pension fund in Sacramento, a college savings account in Texas, and millions of other quiet, unremarkable financial lives that were never supposed to have anything to do with Wall Street in the first place. The deeper and more uncomfortable lesson embedded in every one of these historical episodes, from 1987 to 2001 to 2010 to 2020, is that modern economies do not run on capital alone. They run on trust, on the shared and largely unspoken assumption that buyers and sellers will be able to meet, transact, and agree on a price every single trading day without interruption. That trust is built on functioning technology, transparent information, coordinated emergency response from regulators and central bankers, and a financial infrastructure resilient enough to absorb shocks without collapsing entirely. Every time that system has been tested, whether by an act of terrorism, a runaway algorithm, or a once-in-a-century pandemic, it has bent without fully breaking, in large part because of layered safeguards built specifically in response to the last crisis that exposed a weakness nobody had planned for. But resilience is not the same thing as invulnerability, and the financial infrastructure holding up the retirement accounts, mortgages, and small business loans of hundreds of millions of ordinary Americans remains, as regulators themselves openly acknowledge, only as strong as its most exposed technological link. The reassuring version of this story is that markets have weathered every previous shock and come back stronger, with new safeguards built directly from the lessons of the last failure. The unsettling version is that each new safeguard has been a reaction to a crisis nobody predicted in advance, which raises an obvious and uncomfortable question about what the next uncontemplated vulnerability might look like, and whether the next generation of circuit breakers, liquidity backstops, and coordinated emergency response will be built before or after the world discovers exactly where the system's next weak point happens to be hiding. It is worth sitting with just how concentrated the ownership of this system actually is, because that concentration shapes who feels the pain first and who feels it worst. The wealthiest 1% of Americans hold roughly half of all publicly traded equities in the country, a stake worth something on the order of $27 trillion, while the top 10% by wealth control close to 90% of total household wealth in the United States. The bottom 90% of the population, meanwhile, holds a slice of the market so thin it barely registers next to what the top 1% controls on its own. That asymmetry means a prolonged shutdown does not strike every household with equal force. A retired executive with a diversified brokerage portfolio and a professional financial advisor can absorb weeks of uncertainty without changing a single daily habit. A retail worker whose only exposure to the market comes through a modest 401k balance built up over a decade of steady contributions experiences the same shutdown very differently, watching a number that represents years of sacrifice sit frozen and unknowable, with no ability to move it to safety and no professional guidance readily available to help make sense of what is happening. Generational exposure follows a similar pattern. Baby boomers hold well over half of all household-owned equities in the country. A fact that matters enormously in a scenario like this because boomers are also the generation closest to actually needing that money, drawing it down for retirement income rather than letting it compound quietly for another 20 years. A shutdown that freezes trading for even a handful of days lands with disproportionate force on people who do not have the luxury of time to simply wait out the disruption. Dynamic financial planners have long warned about when discussing sequence of returns risk. The idea that a market shock arriving at exactly the wrong moment in someone's retirement timeline can inflict damage that a similar shock earlier in their working life would never have caused. There is also a slower, less dramatic version of this same vulnerability that does not require a headline-grabbing shutdown at all, and in some ways it deserves just as much attention as the dramatic scenario that opened this story. Financial regulators have spent years documenting the growing dependence of the entire trading system on a small number of shared technology providers, data centers, and third-party software vendors. The same kind of infrastructure concentration that turned a single vulnerability at one software vendor into an exposure event touching more than 1 million customers across dozens of financial institutions in a widely documented 2026 incident. The old assumption that large, heavily regulated banks and exchanges represent the weak point in the system has been quietly overturned by the reality that many of those same institutions now depend on a handful of vendors who face far less regulatory scrutiny, meaning the most exploitable seam in the entire financial system may not be a bank or an exchange at all, but an unglamorous piece of shared infrastructure sitting several layers removed from any institution a headline writer would think to blame. This is precisely the kind of interconnected fragility that turns a contained technical failure into the sort of systemic event this story imagines, not because any single institution failed catastrophically, but because so many institutions turned out to be quietly leaning on the exact same load-bearing beam. None of this is meant to suggest that a total multi-day shutdown of American financial markets is likely, or that ordinary households should treat their retirement accounts with panic rather than patience. The system has been tested by war, terrorism, algorithmic malfunction, and pandemic, and in every case, it has found its footing again, often faster than anyone expected in the darkest hours of the crisis itself. But the value of walking through a scenario like David's is not to predict doom. It is to make visible a piece of infrastructure that functions so smoothly, so invisibly, day after day, that most people never think about it at all until the one morning it stops. The lesson that keeps surfacing across every real historical precedent examined here, from the 4-day closure after September 11th to the 4 circuit breaker triggers in 10 trading days during March of 2020 to the 36-minute algorithmic spiral of May 2010, is that the American financial system is simultaneously more resilient and more interconnected than most people assume, capable of absorbing extraordinary shocks precisely because regulators, exchanges, and central bankers have spent decades building overlapping layers of protection in direct response to whatever the last crisis exposed. Whether that pattern of building the next safeguard only after the last failure reveals itself is fast enough to outpace whatever the next unforeseen vulnerability turns out to be remains the open question, sitting quietly underneath the entire system, waiting, as it always has before, for the morning nobody saw coming. There is one more thread worth pulling on before closing the book on David's Monday, because it points toward a risk that regulators themselves are only beginning to fully grapple with. The 2010 flash crash happened at a time when high-frequency trading firms already accounted for somewhere between 50 and 70% of all equity trading volume, and researchers studying that event described the core danger, not as any single algorithm malfunctioning, but as a phenomenon they called algorithmic collision, where thousands of independent automated systems, each individually rational and each simply reacting to the data in front of it, interact with one another in ways no single programmer designed or anticipated, producing a collective outcome that looks, from the outside, like panic, even though not a single human being made an emotional decision anywhere in the chain. Analysts studying catastrophic risk scenarios have pointed to that event specifically as a historical preview of a broader category of danger, one where a loss of control over a complex system does not require any dramatic villain or sudden leap in capability, only an ever-increasing density of automated decision-makers occupying the same shared environment, each one optimizing for its own narrow objective without any of them holding a view of the whole. As artificial intelligence systems become more deeply embedded in trading strategies, risk modeling, and even the algorithms exchanges themselves use to manage order flow, that dynamic does not disappear, it deepens. And some of the very same researchers who study AI safety in other contexts have begun pointing to financial markets as one of the clearest real-world examples of what it looks like when a system built from many individually sensible automated pieces produces an outcome that serves nobody's interest at all. This matters for a story about a market shutdown because the next disruptive event, whatever ultimately causes it, is increasingly likely to unfold at machine speed rather than human speed, compressing what once might have taken days to build into a crisis that develops in cascades within minutes, testing whether circuit breakers designed a decade or more ago can still keep pace with a trading environment that has changed dramatically since those safeguards were first written into the rulebook. None of that diminishes the more mundane but equally important economic role markets play every single day the lights stay on. Small businesses like Rachel's depend on functioning capital markets even when they never plan to go public themselves, because the same banks extending her line of credit rely on healthy capital markets to fund their own balance sheets, price risk accurately, and maintain the kind of liquidity that allows them to keep lending through good times and bad. Startups across the country depend on a pipeline that begins with venture capital and often ends, years later, with a public stock offering that allows early investors to exit and redeploy their capital into the next generation of new companies, meaning a prolonged disruption to public markets does not just freeze existing wealth in place, it quietly starves the pipeline that funds tomorrow's job creation as well. This is the quiet, unglamorous truth sitting underneath every dramatic headline about a market crash or a trading halt. Wall Street is not a closed loop serving only the wealthy investors who watch it most closely. It is connective tissue, linking a retiree's monthly pension check to a home builder's construction loan to a small manufacturer's line of credit to a public school district's municipal bond, all of it running quietly and invisibly in the background of ordinary American life until one morning, for reasons that could be as mundane as a corrupted software update or as serious as a coordinated cyber attack, it does not. Regulators have not been passive observers of this growing complexity. The Securities and Exchange Commission holds emergency authority to suspend trading in any individual security for up to 10 trading days whenever it determines that action is necessary to protect the public, a power it has used sparingly but decisively during periods of acute uncertainty, and the coordinated market-wide circuit breaker system itself represents one of the most deliberate pieces of financial engineering ever built specifically to slow down panic long enough for rational decision-making to reassert itself. The Federal Reserve, for its part, maintains a permanent toolkit of emergency measures, from discount window lending to repurchase agreement operations to outright asset purchases, all designed to inject liquidity into the banking system, fast enough to prevent a shock in one corner of the market from freezing credit everywhere else, tools that were deployed within hours of the September 11th attacks, and again within days of the March 2020 circuit breaker cascade. What makes David's Monday morning worth imagining, even though it never actually happened, is that it forces a rare moment of attention onto a system engineered specifically to never need that attention in the first place. A system built, layer upon layer, safeguard upon safeguard, precisely so that ordinary people like David, Rachel, and their daughter can go about their lives never once wondering whether the bell will ring tomorrow morning the same way it has for the last 200 years.